China's recent reduction in U.S. Treasury holdings marks a significant development in global finance, reflecting a cautious but strategic reorientation in response to rising geopolitical uncertainty and economic shifts. Over the past 3 consecutive months, China has decreased its holdings of U.S. government debt, bringing the total down to approximately $756.3 billion, the lowest level in over 16 years. This decline is not an isolated event. In March, China reduced its holdings by $18.9 billion, followed by another $8.2 billion cut in April, and an additional $900 million in May. As a result, the United Kingdom has overtaken China as the second-largest foreign holder of U.S. debt. These moves align with a broader trend of de-dollarization, a shift away from reliance on the U.S. dollar in global finance, also seen in actions taken by other emerging economies. Several motivations underpin China's cautious adjustment. At the forefront is the mounting concern over the long-term stability of U.S. fiscal policy. With America's federal debt now exceeding $36 trillion and annual interest payments approaching $1 trillion, doubts have grown about the sustainability of such levels of borrowing. The U.S. has faced credit rating downgrades, and legislative battles over the debt ceiling have added to investor anxiety. For a major holder of U.S. securities, these developments present material risks. China's approach also appears to be shaped by international developments. The financial sanctions imposed on Russia following its full-scale invasion of Ukraine in 2022 served as a wake-up call for countries holding large quantities of U.S.-denominated assets. Russia experienced widespread asset freezes and financial restrictions, illustrating how geopolitical tensions can lead to financial penalties, even beyond the battlefield. China, observing these consequences, may be seeking to diversify its reserve structure in anticipation of similar risks. Part of this strategy involves increasing its gold reserves. As of mid-2025, China's central bank has boosted its gold holdings for 8 consecutive months, reaching nearly 2,300 metric tons. Gold, as a tangible asset not tied to any single currency, is considered a traditional hedge against political and economic instability. In this context, it serves as a safeguard against potential sanctions or other financial pressures. At the same time, China has been advocating for broader use of local currencies and alternative payment systems within international forums such as BRICS. This effort, also supported by countries like Brazil and Saudi Arabia, is aimed at reducing dependency on the U.S. dollar in global transactions. Though such moves remain gradual and complex, they reflect an evolving view of financial sovereignty. In Europe, where the energy crisis and security risks from the war in Ukraine continue to reverberate, these developments are being watched closely. European economies are deeply tied to both the U.S. and China, and shifts in reserve management can have ripple effects through bond markets and currency valuations. In fact, as China reduces its U.S. exposure, it may reallocate some capital toward European debt markets, where yields have recently become more attractive. However, structural limitations and liquidity concerns make a full-scale pivot unlikely. Domestically, Beijing is also weighing its economic and strategic priorities. Tensions in the Western Pacific, especially around the Taiwan Strait and the South China Sea, add an additional layer of uncertainty. Should a regional crisis erupt, China could face sanctions or financial countermeasures similar to those imposed on Russia. Reducing exposure to dollar-based assets is thus not only a financial move, it's a form of geopolitical risk management. Still, China is proceeding cautiously. A rapid sell-off of U.S. debt could destabilize global markets, leading to a decline in bond prices and a spike in yields. This would not only harm the U.S. economy but also reduce the value of China's remaining holdings. Moreover, such a move could trigger broad financial repercussions, including losses in other dollar-denominated assets and potential strain in China's own markets. Analysts widely agree that no single asset class currently matches U.S. Treasuries in terms of liquidity and safety. Alternatives like European debt and Japanese bonds have limitations, and gold, while stable, is not easily scalable to the trillions of dollars held in reserves globally. Therefore, while China's reduction in U.S. debt holdings signals a desire for diversification, it is not a wholesale rejection of U.S. assets. Ultimately, China's evolving reserve strategy appears to be a measured attempt to prepare for a more fragmented and uncertain world. The objective is not to provoke instability but to mitigate future financial risks, especially those tied to geopolitical confrontation. The war in Ukraine and the West's coordinated response against Russia has underscored how finance can become a theater of strategic contest. By managing its exposure today, China is seeking to shield itself from potential economic turbulence tomorrow.